So verified approval letter is essentially a fully underwritten uh, approval looked at by an underwriter.
Okay.
So some differences are, you know, with with traditional mortgages or traditional purchase of a home, you need a pre-approval letter or a
Yes.
pre-qualification letter, and those are different than a verified approval letter.
Okay.
So some of the differences are a pre-approval letter. Uh, Essentially, a lender says, "Okay, well, we may let you borrow money. We may not let you borrow money. We're not sure yet." So you supply them with, they run your credit, right? First of all, they run your credit. Then they ask you for a tax return, maybe a pay stub, maybe a W-2. Um, and they look at that and say, okay, yeah, well, we'll probably lend you the money to purchase this property. But it's not guaranteed. It's not a guarantee that you'll get the money.
Okay. Now it sounds
So
similar to a DU approval, a desk underwriter approval.
it is a desktop underwriter approval, yes, but desktop underwriter approval does not necessarily verify uh, everything, your financial items that you supplied. So the desktop underwriter is not going to verify your income tax return. They're not going to verify your employment. Um, the only way to do that really is to get into a full underwrite, where the underwriter actually gets your entire file, 2 years tax returns, 2 years W-2s, 30 days of pay stubs, 2 months of bank statements. They get all of that and they verify your tax returns. They verify your employment. They verify that you have the money in the bank. Um, so once they verify all of that, then that's what's called a verified approval letter. They can now say with certainty, okay, you definitely qualify for this amount of money. We've looked at your tax returns. We've looked at your pay stubs. We know that you can pay us back. So we will give you the money to buy this home. We will lend you the money. They won't give it to you. They'll lend you the money to buy the home or investment property.
Okay. Okay. Now you had mentioned before there were private parties that were providing loans. This is not having to do with that, right?
No, not at all. Not at all.
Okay.
These are your traditional lenders. These
Okay.
are your traditional lenders that most people hear about.
Okay. Okay. And so the advantages that in your mind, the advantages if someone has this verified approval letter as opposed to a pre-approval letter is in terms of what's the main advantage?
So with a pre-approval letter, again, when you go, like if you want to make an offer for one of your clients and they say, I want to buy, Luis, I want to buy this home for, this amount of money. And when you make that, when you put in that offer, you typically want to have a pre-approval or a pre-qualification letter with that offer, which really tells the seller of the property, hey, this person is serious about buying my property. They may not have the money yet, but they're actually looking into getting the money uh, in terms of a loan to buy my property.
Okay.
With a verified approval letter, you're telling the seller, hey, this person has already qualified for the loan. There's no question that they will qualify for the loan. The underwriter has verified their income, their tax return, everything's been verified. So you're coming in with a much stronger offer.
Okay. And there's still when they make the offer, it's not a cash offer, so there is an appraisal and loan contingency.
Right. There actually is no loan contingency. You can remove that because the loan itself has actually already been approved.
Okay.
Now, you still have to have an appraisal contingency.
Yes.
Um, that tells you the value of the home because most lenders, um, really all lenders want to know that if they're going to loan you this money on certain purchase price, that the value of that property meets the sale price of the property.
Okay. Okay. So
So
the person is going to be able to make the offer and not have a loan contingency, but they will have the appraisal contingency until that's
they will. They can. I mean, I've done some of these um, with verified approval letters. one of the last ones I just did, we did the verified approval letter, and we were able to remove the appraisal contingency because it was not required. And it was through a very traditional mortgage lender. So their offer actually was not the highest offer on this home, but their offer was accepted because they went in without a loan contingency because of the verified approval letter, and without an appraisal contingency because, well, it wasn't needed. Appraisal wasn't needed for the loan.
Okay.
So what that did for the seller was say, hey, you know, this person's going to buy my home. They still had the inspection contingency, which any buyer, I don't care if you're an all cash buyer, you're going to have an inspection contingency. You know, you want to make sure that the place isn't falling down when you buy it, right?
Yeah.
And so they were able to remove the two biggest hurdles, which are the appraisal, I'm sorry, the loan, and then the appraisal.
I see.
So
they're making the offer without those contingencies, that they feel the value is there. And so that's a stronger offer to the seller. And you're saying that the seller has the assurance that it's going to close, and it's taken much more seriously.
Exactly. It was essentially like if they were an all cash buyer. So, you know, all cash buyers come in and say, we don't need a loan contingency. A lot of times they don't even have an appraisal contingency. We just want, you know, a 10-day or whatever day inspection contingency. And after that, you know, we can even close sooner. Mm-hmm. So on this particular deal, the buyer's agent was able to make an offer with no loan contingency, no appraisal contingency, and a 15-day close.
Wow.
Right. So that just, nobody could compete with that. Even if they're offering $20,000, $30,000, $40,000 over the asking price, the seller went with my client because they were basically guaranteed to get the money.
Okay.
Right. Short of the inspection contingency.
I see. And so then the 15-day escrow, the 15-day close, how does that happen so quickly?
Well, that happens quickly because what takes time in pretty much any transaction, as far as a loan is concerned, is gathering all the documents from the buyer, verifying income, verifying tax returns. That can take some time. Then you have to order the appraisal, and that can take some time.